What is an operating lease versus a capital lease? Well, to start with, let's begin with operating lease. An operating lease is the most common form of lease you see with regard to equipment. And generally, in terms of accounting for the lease, you account for it generally as an operating expense. There's no capitalization aspect to it. The asset is not present on the balance sheet in that way. It is simply, there is the obligation there once again to make lease payments, which is again an expense on the income statement. So what is the eligibility to be an operating lease? Well, basically you have to distinguish it from what would otherwise constitute a capital lease. So to start with, there's no option to purchase at the end that is a bargain purchase or some small fraction of the total value or the fair market value of the asset at the end. So basically, here are the criteria. The term of the lease has to be for less than 75% of the total useful life of the asset. The value of the lease, that is all payments made throughout the life of the lease, has to be less than 90% of the fair market value of the asset at the beginning of the lease at that time. And throughout the lease, the risk of loss remains with the lessor of the property. Even if the lessee does have insurance or pay towards maintenance of the item, still the risk of loss of the item entitled to the item still remains with the lessor. Now let's look at the capital lease. The capital lease is quite different in that it's treated more like actually owning an asset, because that's really the scenario. It's more like a financing situation. The value of the property is recorded on the balance sheet as an asset, and then the obligation to make lease payments is recorded as a liability on the balance sheet. So with regard to the income statement, basically any depreciation of the asset taken over time or interest accounted for over time is recorded as an expense on the balance sheet, but by and large, that's it. Okay, it's treated more like an asset that's owned and being paid for over a period of time. Now, the same criteria that distinguish the operating lease also distinguishes the capital lease. That is, at the end of the term, there needs to be some right to purchase the asset at a discount or at a extreme lower value than it would otherwise be worth. Less than fair market value, we can say. The lease term has to be for more than 75% of the useful life of the property. The value of the lease is more than 90% of the purchase value, equal to or more than 90%. And the lessee assumes, as if they were owner, they assume the risk of loss on the asset. They pay the taxes, they pay the maintenance, they generally hold insurance on the item. So basically, for all intents and purposes, they treat it as if they own the property. So the capital lease is generally treating it as a purchase finance scenario, where the operating lease is more of an expense drawn out over time.